everyone. Today we will be talking about the cost of capital. So now let's start with the introduction part. Now cost of capital, when we talk about the cost of capital, there are two words. One is cost and one is capital. And I think till now we have done so many of the parts of the capital in the previous video. You must be aware about the what do you mean by word capital. So the capital means the amount that you have invested in the business. So that means, first of all, whenever you are going to start a business, you must be requiring the funds to do the business. And as we have already done that, there are various sources from where we can collect the capital. And if we talk about the capital, capital can be borrowed by way of your own money. That means you can invest your own money in business, or you can borrow the money from the banks. Or if I talk about the shares, that means you can borrow the money by way of equity stock, or we can also name it as equity shares or preference shares, or even by debentures. You can borrow it by bonds. We have done about the sources of finance. We can do it by factoring, we can do it by commercial papers, or there are various sources from where we can borrow the money. But now, whenever we are talking about word capital, we are not talking about the short term borrowings. We will be talking about the long term borrowings. That means the sources from where we are going to borrow the money for a longer period of time. Now, second thing, we all are aware that nothing is free in this world. You are going to purchase a product from the market, you have to pay the prices for that. Similarly, whenever you borrow anything, you have to pay something in return. For example, I need the let's say I need the carpet from my house. There are some guests that are coming, so I need the carpet. So I don't want to purchase the carpet, I take it on the rent. So that means if I'm borrowing the carpet for my house, I have to pay rent for that. So that means if carpet is coming in, rent is going out. So the thing is that nothing is free in this world. If I am taking the carpet on rent, I have to pay some amount for that. So if you are taking some services, again you have to pay some price for that. You want to give advertisement for your product, you have to pay some price for that. So nothing is free in this world. Similarly, if I have to borrow the money for the business, if I have to borrow the money from the banks will charge some interest on that, because they are giving you the money. You are utilizing their money for a period of time. That means maybe for 1 year, maybe for 5 years, maybe for 10 years. You are utilizing their money. So that means you are borrowing, so you have to pay something in return. So bank charges interest. Now, if we talk about debentures, on debentures also, that means you are borrowing the money from the general public. And if you are borrowing the money from the general public, you have to pay interest to them. If you are borrowing the money by way of bonds, again you have to pay interest. If you are borrowing the money by way of shares or debentures, you have to pay dividend for them. That means nothing is free in this world. Even if you are borrowing the money, you have to pay something in return. So that is named as a cost. And whenever we are paying that cost to someone, we have to earn that cost also. For example, if let's say I need the money worth rupees 100,000, I want to invest in my business. So I borrowed the money from the bank worth rupees 100,000, and bank says that I will charge 10% interest on that. So that means I have to pay 10,000 to the bank. Now, if I have borrowed 100,000 from the bank, I'm not going to keep this 100,000 in my pocket. Because if I'm going to keep this 100,000 in my pocket, I have to pay 10,000 from my own pocket. So there is no use of doing such a business. So what I'll do, I'll invest this 100,000 in a business, and I will try to earn profit by investing 100,000. And my aim will be that whatever amount I am earning from that investment, that should be more than the interest that I have paid to the bank. That means my aim will be, that means I have to earn minimum of 10,000. So if I am earning 10 more than 10,000, that means I am doing my business is good. That means I am earning profit. If I am not earning minimum of 10,000, that means uh, I'm in a loss. And if I am in a loss, there is no use of doing the business. So that means if we talk about capital, capital has some cost. And what that cost is, we are going to discuss that cost in this cost of capital. Now, as I told you that whatever the cost we have to pay, we have to earn that cost. And whenever we are taking any decisions in business, for example, in future, I'll be teaching you about the capital budgeting part. So whenever we are talking about the capital budgeting part, we will be requiring the cost of capital. That means what cost is being incurred to borrow the money by way of either by way of loan, either by way of shares, either by way of debentures, or by any way. If I am borrowing the money, I have to pay some cost. So we will be discussing that also. Now, whenever we talk about the word cost of capital, it has some different names. For example, it will be also be named as a hurdle rate. It will also be named as a target rate. It will also be named as your minimum rate of minimum required rate, your cutoff rate, your discount rate, your inflation rate. So there are various other names by which I can say that you can just, these are just the synonyms of your cost of capital. So what we learned that whenever we are doing business, we need some funding to do this business. So there are different sources, and over here we will be talking about the long-term sources only. So what we have done, we have divided the complete sources in two parts. One is debt. Debt means borrowing. That means whenever we borrow the money, we have to pay back that money at the maturity period. And one is your equity. Till now, you must be aware about what is equity. That means we are borrowing the money from the general public, and we are saying that you are becoming the partners in my business, and whatever profit is left after paying the interest, after paying the taxes, or after paying all my debts, whatever money is left, that will be distributed to the equity shareholder. But again, they don't have a guarantee that they will get the amount of profit. So now we are dividing debt in three parts. One, we will be talking about debentures. Second, we will be talking about bonds. And third, we will be talking about the loans. Now, this is what is the crux of what is cost of capital, what we are going to talk about. Now, whenever we talk about this cost of capital, we are borrowing. Now, the question arises whether we should borrow by debt or we should borrow by equity. And if I'm going to borrow the money by debt, whether I should borrow the money from debentures, whether I should borrow the money from bonds, or whether I should borrow the money from loans. Now, whenever we are discussing that from where I have to borrow the money, the aim of every business is to minimize the cost. If the cost is minimized, then only the profit will be maximized. Because we all are living in this competitive world, and where our competitors are also there. If they are selling some product, let's say if I'm talking about some product, if they are selling some product, let's say at worth rupees 10, and my product cost is, let's say, 20. So that means I will be losing my customers. So what I have to do, I have to keep the price of my product similar to my competitors. Now the only way to increase my profit is to reduce my cost. So the first one of the aim of the business is to increase your profit. Or you can say, as we have already done, the main aim is to wealth maximization. And wealth maximization means when your investors will be happy, and investors, they will be happy when I'm giving them more dividend to them. So if I have to pay more dividend, I have to earn more. That means my earning before interest and tax should be increased. And that will be increased when my cost will be minimum. So the one of the point to increase the wealth maximization, or to increase the profit, to increase the earning before interest and tax, is to minimize the cost. So I'll try to borrow the money. Being a company, I will try to borrow the money from those sources where I have to pay less interest or less dividend. Now, we have these many sources. I have debentures, bonds, loan, preference shares, equity shares, retained earnings. Now the question arises from where I should borrow. So there are various factors on which it depends that whether I should borrow by way of debentures or I should borrow by way of equity or I should borrow by way of bonds or I should borrow by way of loans. I should invest my own money. I should borrow by preference shares. So let's discuss the what are the factors which are determining your cost of capital. Now let's talk about the first factor which is known as risk-free interest. Now as you are aware about the word risk-free, risk-free means when I am borrowing or other person is investing the money in my business, I am borrowing the money. It does not carry any risk. For example, if I am investing in government bonds, for example, if I am investing in some fixed deposits in the bank, so what I am going to do in this, if I am going to deposit the money in such type of investment where I am going to get the fixed amount of interest and there is a guarantee that on maturity also I'll get my money back. So when such type of situations are there, we name it as a risk-free interest rate. Now, if we talk about this risk-free interest rate, it mainly depends upon the demand and supply of funds in the market. Now, if the demand of the funds is less as compared to supply of funds, then the rate of interest will fall and vice versa. Second factor is business risk. Now, business risk means two words, your business and risk. That means the risk which is associated with the business. And if I'm talking about the risk which is associated with the business, is that there is a variation in your profit. Now, why the variations are there? Now, variations can be there due to some happening in the business, or the variation in the profit can be there due to some external factors which I am unaware of. For example, we all know that COVID-19 came. We all are unaware about it that this pandemic will be there, and we have never thought about this pandemic. So that means when this pandemic came, no one is aware, and it has affected the business. There was a lockdown, so that means business are being affected, and if the business is affected, there is a variation in the profit. Some companies are earning profit, some were in a loss, people are losing their jobs. So that means if people are losing their job, that means business is not having this much of amount to pay the salaries. So that means they are laying off. So that means there is a risk. This risk is due to some external factors. But if I talk about other way around, let's say I say that there is a lockdown in some particular company. There is a fight among the labor and the lockdown is there. But demand for one company is not as much as the demand for other company products is there. So that means if the demand is decreased or the company is not having the raw material, so that the company is not able to fulfill the demand of the customers, or there is some internal problem in the company. So business risk can be associated with two factors. One is the risk which is associated within the company. That means if the risk is there, some happening is there within the company which is controllable. But there is a risk which happens due to some external factors which is beyond our control, as I told you about the demonetization, as I told you about the COVID-19. Or we have also talked about demonetization part. This our country just go for demonetization, we are unaware about it. But let's say government changes the policy. Or if you have seen about this climate crisis, these Russia-Ukraine war, all these things are affecting it. Or if I talk about subprime mortgage, it happens in US, but yes, throughout the world it was affected. The businesses are affected. Even currently this SVB, Silicon Valley Bank crisis were there. So that means some crisis that is happening that is not beyond my control, that is also affecting my business and that is affecting my profit, and some factors which are within our control that are also affecting my business. The factors which are not in my hand, that is which is beyond control, some external factors, we name it as a systematic risk. And the factors which are within my control, that means I can control it, which is within the company, that is named as unsystematic risk. So these business risks also determine my cost of capital. So what kind of risk is there? So whatever these risks are, we can say these are diverse in nature, and these risks are affecting the profit of the company. And if profit is being affected, we can say my cost of capital is effective. If company is having more profit, company is not going to borrow the money by way of equity shares, because whatever the profit is there, you have to distribute it. So more profit means less amount borrowed from equity, more from the debt, because I have the paying capacity, I can pay it off. But if I am having a less profit, I don't have money to pay it to the shareholders, so I'm not having the money to pay it to the debenture holders on time, so I'll try to borrow it from the equity shareholders. Now next is your financial risk. Now as we talk about business risk, it's related to the operation of the business. I'm talking about profit and loss about the business. But financial risk means the risk which is associated by the funding of the business. The word financial means sources of finance. That means if you are borrowing more by your debt, either by way of loan, either by way of bonds, either by way of debentures, that means, and if you are borrowing by these three things, so we have to pay the interest to the debenture holders, bond holders, and even to the bank. And this interest is irrespective of my profit. If you are going to borrow the money from the bank, let's say I want to take the house loan from the bank, and I have to pay interest every month, I have to pay interest. Do you think bank will consider whether I am having a job or not, whether my business is running in a good condition or not? No, bank is not considering my condition, financial condition. They say that I have given you the money, pay my interest, pay my principal amount. So that means if you are not having the capacity to pay back the money, you are under the financial risk. Or I can say that financial risk does not mean your business is not running. Financial risk means you are not able to pay the debts. For example, I am having a profit, but I am able to earn the profit. Profit is you can see in my balance sheet, you can see in my profit and loss account that I am earning the profit. But that profit is not in the cash form. That profit is in the form of debtors. So that means if I am not having a cash in my hand, I will not be able to pay interest. I will not be able to repay back the money to the debenture holders. So that means that is known as your financial risk, when you are not able to fulfill the financial responsibilities. So that means if you are taking higher level of debt, the higher financial risk will be there. Okay, next we talk about your current dividend policy. Now, if we talk about your current dividend policy, the current dividend means the amount of total earnings, that means whatever the company is earning, from that earnings, how much amount is being paid to the shareholders in the form of dividend. Now, whenever you are calculating the dividend, you have to calculate the price earning ratio. And if the price earning ratio will increase, your cost of retained earnings will decrease, because we will have less money to be retained and the use for promoting the business as a source of fund. And if we talk about the price earning ratio, I have already told you in the previous videos, we have already discussed what is price earning ratio means. How much times the investor is willing to pay about my EPS. So that is known as your price earning ratio. So if your current dividend is more, you are paying more amount, that means your earning per share is more. And if your earning per share is more, that means people will see, that investor will see the company is having a growth rate. So that means they will be willing to invest in your company, and you can borrow by way of cost of capital or cost of equity also. Now, The next is your current income tax rates. Now, if we talk about income tax, we all know that before paying the income tax to the government, we have to pay interest to the debenture holders, we have to pay interest to the bond holders, and we have to pay interest on the loan. That means what the government is saying, if you are borrowing the money and you are going to pay the fixed rate of interest, and on the maturity you are going to repay the money back, so in that case government is giving us the tax shield. We don't have to pay taxes on the interest that we are paying on the amount borrowed. For example, let's say you are having a profit of 100 rupees, and from that you have to pay, let's say 20 rupees by way of interest. So if you are paying 20 rupees as an interest, so you are left with 80 rupees. And let's say government is charging 50% tax rate. So government is saying that whatever amount is left after paying the interest, that means you are left with 80, you have to pay taxes on that 80. It means if government is charging 50% tax rate, I have to pay 40 as a tax, and remaining 40 will be the equity shareholders fund. So that means from 100, whatever I have earned, I have paid only 40. And if you have not borrowed from by way of loan, by way of debentures, by way of bonds, that means you don't have to pay interest on that. And if you don't have to pay interest, your earnings will be 100. Now the government says that you don't have borrowed the money from the bond, or that means you have not borrowed the money by way of debt, so you don't have to pay interest. So pay me the tax on the amount you earn. That means you have to pay taxes on 100 rupees, and 50% of 100 is 50. So now you are going to pay 50 rupees as a taxes. Previously, when you have borrowed the money by way of debentures or bonds or loan, you get the tax shield on the amount, that the interest that you are paying to the investors. So you get the tax rebate, this tax shield. So that means your current income tax rates also depends your cost of capital. If your current income tax rates are higher, so you will try to borrow it from the debenture so that you can get the tax shield. And if your current income tax rate are less, so you will try to borrow by equity, because you will not be getting more amount of tax shield for that. Now next factor is your current economic condition. Now current economic condition, let's say if I say that if banks are growing, that means if banks are growing, the condition of banks are good, that means they can easily give the loan at the low rate of interest, because they need to increase the sale for the stability of their products. Over their products, they are selling the loan. They are giving the money to the people to invest in the business. So that means if they are going to charge high rate of interest, less people will borrow. I have to take house loan, I will always try to borrow the money from those banks which are charging less interest from me. So that means if the banks are charging low rate of interest, they will be able to sell their sellability of their products. And at that time, company's cost of debt will decrease, which is the part of company's cost of capital, because people are borrowing by loan. So company's debt will decrease because interest is less. So company will also pay less to the investors. So company's cost of debt will decrease. So I can say not just the banks, but the whole economic condition should be okay with this. And if there is a big recession in the market, no financial institute will decrease the rate of interest, because recession is there. They have to pay the interest to the people who have invested their hard-earned money in the bank. So they will not decrease the rate of interest, since they have to pay it to the customers. It means every loan providing company also have the cost of capital, because they are giving the interest to the investors. If I am putting my money in my bank, so I'm getting some interest on that. So bank is also having cost of capital. If I am going for a FD, fixed deposit in a bank, so they are giving me the interest. Even on the saving bank account, I am getting some interest. No matter whether I'm getting 2%, 3% or 4%, but still I am getting some interest. So the interest that the bank is giving to me, that is a cost for them. Now, if there is a stability in the market, cost of debt will decrease and the cost of equity will increase. Now, next is your current capital structure. Now, as I have discussed that whenever we are borrowing the money to invest in business, we have to see whether I have to borrow the money by way of equity, whether I have to borrow the money by way of uh, debentures, or you can say debt. It also depends my cost of capital. For example, if I am borrowing more by debt, and if I'm borrowing more by debt, it means the less interest I have to pay, because debentures, bonds, and loans are considered as risk-free investment. People are getting the fixed rate of interest, and at the maturity they will get the fixed amount. So that means they are tension free. They will get their money back irrespective whether the company is having profit or not. So they will demand less rate of interest on that. And equity shareholders, because no dividend is guaranteed to them, even they are not aware whether they will get their money back or not, whether the company will buy back their shares or not, whether they will, even the company is having the profit, there is no guarantee that that profit is distributed as a dividend. So equity shareholders are having more risk. So that means if company is having more and more of debt, the cost of equity, that means equity shareholders risk, will increase. And if the equity shareholders risk will increase, they will demand more dividend. So that means the capital structure, whatever the capital structure you are talking about, that whether you are talking about debt, whether you are talking about the equity, so combination of debt and equity also affects your cost of capital. Next is your financial and investment decision. Now, when we get new share capital by way of debt or by way of equity, we have to tell to the fund providers about the usage of their fund. Because if you are giving your hard-earned money to the company, you will be keen to see whether the company is investing my amount in a fruitful business or not, whether the company will be having a profit from investing that amount or not. So you will be interested in the company's profit and loss account. You will be interested to see whether the company is having profit or not, because if you are an equity shareholder, you will see if the company is having more profit, company is having more growth, you will get more amount of dividend, or even the value of the stock in the market will be increased, the goodwill of the company will increase. So that means you are interested in that. And if there is more risk in investment, both the shareholders and creditors will get the high reward for this, because they say that we are taking the risk, we are giving you our hard earned money. So that means if there is a risky investment, the return will be more. So more risk, more return. So both the financial and investment decision will affect your cost of capital. Now, till now we have seen that there are different parts that we have to study about the cost of capital. So what we have learned, that the cost of capital is the cost of raising funds for the company. From whatever sources you are raising fund, you have to pay something in return. So we will be studying about the different components. First is if you are borrowing by way of debt. By way of debt means by way of debentures, loans and bonds. So we will be studying about the cost of debt. What is the cost of borrowing the money from these sources, and the abbreviation will be KD. If you are borrowing the money by way of preference shares, so what dividend you are paying, that will be my cost. So we will be studying about cost of preference shares, which is named as your KP. Cost of retained earnings, if I am investing my own money in business, so that is my opportunity cost. So I'll be talking about the cost of retained earnings, which will be named as KR. And cost of equity capital, if I am borrowing by way of equity shareholders, I am investing the general public money, I am making them the partners, so I have to pay dividend to them. So that is known as cost of equity. So I'll be talking about K. So these four combination will be named as your cost of capital. If I combine the cost of all the four components, I'll be talking about the cost of capital. So hope the basics of cost of capital is clear. In the next class, in my next lecture, I'll be starting about the cost of debt. Or for your further reference, you can refer my book, Financial Management. Thank you.